Global macro never disappoints. Today it's Tuesday, the 20th of December, and we've had an action-packed day with Bank of Japan out with a message in the very early morning, now allowing the 10-year bond yield to trade up to 50 basis points. And oh boy, we've had global ramifications of this decision from Bank of Japan. So today we're going to ask the question, did the Bank of Japan just wreck Powell's plan? And I'm joined by a couple of great guests today to discuss this question. First of all, welcome to our editor in Tokyo, Weston Nakamura.
Good morning, gentlemen. How are we?
Good. Good to have you on a day with a lot of action from Japan, but also a warm welcome to Dale Pinkert, the head of trader development at TradeGateHub.
Thank you very much, Andreas. It's great to be with both of you guys.
But before we get started, if you've been wondering what the hell to get people for Christmas, I've got an idea. What about a Real Vision membership? You can do exactly that if you head to www.realvision.com/give-a-gift. It's the perfect gift if you ask me. But back to you, Weston. We need to unpack this action from Japan. Bank of Japan took the decision to widen the trade range in the 10-year bond yield from plus 25 basis points to 50 basis points. But that wasn't the only decision they took earlier today. So unpack this Bank of Japan action for us.
Yeah, sure. So I guess it was a huge surprise move, even though, so many people, like the general consensus, had predicted that this kind of policy outcome would come just later on after Governor Kuroda ends his term in 2023 of April. So the surprise was the timing of it. But basically what happened was yesterday for me, Bank of Japan, they expanded their yield curve control target range. And so that would be seen as a kind of rate hike, if you will, because of the fact that JGB 10s have been pinned up against the previous ceiling of 25 basis points and stuck there for the better part of many months. And so by them lifting it, they knew that there was going to be a, shoot up at the 10-year tenor. And look, Kuroda the whole time is saying, this is not a rate hike, this is not a rate hike, this is not a rate hike. And technically it's not, that is true because a rate hike, typically implies front end policy rates, which are kept at minus 0.1%, which is a negative rate, which is still BoJ as the only central bank with a negative rate policy in place. So in that sense, it's not a rate hike. However, when you start to explicitly include the long end, the 10-year yield, and so that is a rate hike. However, on the other hand, and so that would be seen as hawkish. On the other hand, they also increased the amount of their monthly scheduled JGB buying across the full curve from I think it was like 7.2 trillion yen prior to now 9 trillion yen. So you're getting a rate hike and you're also getting increased bond buying, and that seems to be kind of contradictory.
Weston, if we look at the reaction in the Japanese yen, we had a move of roughly 4% from just above the 137 handle versus the US dollar to just above the 131 handle. So quite a move in FX space. 4% is quite a lot when you look at it in foreign exchange terms. What do you make of the Japanese yen outlook after this decision?
Sure. So Brian, that second chart I sent you, if you could put that up. So the yen move was indeed, that you were saying, calling it a yen move, Andreas, and not a dollar move. If you just look at all yen crosses, be it USD JPY, Euro JPY, AUD JPY, CNH JPY, they're all minus 3%, minus 3.5%, minus 4%. Clearly, this is a yen short squeeze move. And the reason it's a short squeeze is because, as you and I have been saying basically all year, the yen, shorting the yen is the global macro trade of 2022, or was, extremely crowded. And because it's more or less a Fed play, because you have front end rate volatility, implied volatility, astronomically high, because which reflects policy uncertainty out of the Fed, and for good reason. And so rates traders who would traditionally take, a directional bet on where policy rates, where Fed funds rates are going to be at what level, at when, that's much harder to do. So instead, they're just playing the relative trade of a dovish or a standstill central bank, which is the BoJ, versus the hawkish Fed. And now what you're getting is a simultaneous Fed potentially, coming to its end of its rate hiking cycle, and then a perceived BoJ who's supposed to be the standstill leg now starting to, potentially begin a rate hiking cycle, and so that now you're getting a compression or a convergence maybe of policy, if you will, on both sides. Plus, it's December, and the buy side, who has been short the yen, is going to take profits and take their bonus. And so you're getting a lot of position covering and short squeeze in the yen. Specifically, if you look at yen futures, 75 was a very key level. There's where a lot of recent shorts got in. There's a lot of options positioning there too. And so you could see it just blast right through there. And if the next level, you should really need to watch volume on yen futures, volume price action on yen futures, not so much the spot currency for USD JPY. At 80 for yen futures on CME, if it gets there and breaks through there, then we're talking dollar yen at mid 120s to 120, 125 to 127, but cracking into the 120 handle. And that
could I interject something, a question I'd like to ask?
Absolutely.
Weston, please. So Weston, why December? Do you think the BoJ thought in thin market conditions it would be more impactful because markets were, people closing their books for the year, walking away, and you talked about the timing being surprise. Why in December?
Sure. Yeah. So that's such a fantastic question. So I just want to give my kind of my view, my reading on this, because the timing is very kind of shocking, right? Essentially, a lot of people, I think, the general consensus is that this is a rate hike. This is the end of the Bank of Japan, and they're easing. They were the first in. This is the last out. This is an end of an era. This is the last major central bank who is now removing accommodative policy. No more free money. This is the end of that. This is a huge regime shift, not just for Japan, but for major G5 central banks at large and all that kind of thing, right? However, if you look at the policy statement, they don't mention anything about CPI or anything like that. Okay, this has nothing to do with Japan CPI, which has a 3 handle on it, which is high for Japan, but obviously much lower than everywhere else. And so, why would they suddenly, or why are they reacting to it now in this manner, with 2 meetings left for Governor Kuroda's term, right? So this is indeed for financial stability and not for CPI. Brian, if you put up that kind of that GIF that I have, I tweeted this sort of recently, but the Bank of Japan basically conducts a survey of bond market participants. It's about 80 participants. These are people that markets, and they survey them, and you can see that there is a sharp deterioration of bond market, JGB market functioning, such that you get no trade. Sometimes, you have the Bank of Japan owning 80%, 90%, and sometimes even over 100% of certain issues and that's possible because they basically own the entire issue and then they lend them out. You have, inability to price, credit issuance and all that, and just, collateral issues and just so much sort of dysfunction that's coming of this, that they need to just kind of fix the yield curve, and they need to do it immediately. You can't have 7-year, 8-year, 9-year JGB yields not only yielding above the 25 basis point cap that was the previous, but well above the 10-year. So that's why they did it now. And what I think too is that, if you think of it, if you just remove the CPI part out of the equation, right? Because everyone thinks about okay, this is a response to inflation, right? Inflation has nothing to do with this, because inflation is a very Japan is an enigma in that field. And since yield curve control was rolled out, what people don't really realize that Bank of Japan has been beating to its own drum all along, not just this year, but since 2016, right? We've had basically for FOMC, we've had a rate hike, we've had a rate cut, we've had rates kept at flat at the zero bound, then a rate hike cycle again, and now potentially that's coming to an end. All that's been happening, and BoJ's been on kind of yield curve control autopilot this whole time. And so why now? Why after buying half a quadrillion yen worth of JGBs, cornering half of the market, setting the price on the other half, again with 2 meetings left, if not for something that is happening, and that is the deterioration of the JGB market. So I think that if you look at it from that angle, and if you actually just central bankers, they lie a lot. Kuroda spent half his tenure, the first half of his tenure, lying about policy. But if you actually just listen to what they're saying and look at the data, this is about financial stability and financial, markets that have become so dysfunctional that they, because of their very intrusive force in the market, they needed to correct immediately to do so. And that's why you have also that sort of quote contradictory increase in the scheduled JGB buying, just to signal to markets like this is not any sort of policy removal, policy accommodation, like accommodation removal. This is not a rate hike or anything like that. This is to correct the the dysfunction that's happening. And to that end, what the additional thing that
there was urgency. There was urgency for them to go.
It's the
answer.
So it's urgency. So it's actually a very alarming thing, but for different reasons. It's not a Japan CPI thing, and it's not that it's like they are taking emergency measures. There's no really, and conceptually no different from when the Bank of England stepped in.
I was going to bring that
October.
in. Gilts. Yep.
Yeah, exactly. They had to correct. They had to do something immediately.
So this is global. This is global sovereign debt crisis, right?
Possibly. Exactly. But on like a mechanical level. So what I've been flagging is that now the spillover risk that people really need to kind of keep in the forefront of their mind as a very real possibility is that so the JGB market clearly has direct implications on the U.S. Treasury market. The U.S. Treasury market currently is in a state of illiquidity and volatility that are feeding off of each other. And so one day, at some point, you can find yourself waking up to a situation that the UK gilt market was in, but happening in the U.S. Treasury market, where you see the long end of the U.S. Treasury curve, 30-year U.S. Treasuries starting to yield spiking like 100 basis points in the week, and then the Fed would have to step in and directly start buying 30-year U.S. Treasuries. And if that happens at the same time, timing-wise, as when they're still on the rate hiking cycle, and they have to somehow communicate to the markets that this is not a pivot, even though we're bid for unlimited and we're still on a rate hiking cycle, like that is a messaging like disaster nightmare. Like people don't believe the Bank of Japan right now. People don't believe the Fed right now, as it is. And so that's like a serious risk that can happen. That I just want to make sure that people are aware of. But again, this is just deterioration of like actual functioning of markets of of themselves, and not really sort of the real economy.
Weston, final question before we allow you to get some sleep over there in Japan. Kuroda is about to end his term. Is it in April next year? And we've had a lot of discussions ongoing in the international media whether that will sort of alter the picture policy-wise for Bank of Japan. After Kuroda, what comes next? If we look at pricing, the market now expects Bank of Japan to leave the negative interest rate policy sometime towards the summer next year. Is that a feasible scenario if you're the judge?
On the policy rate, the negative rate? Yeah, because for them to leave it there, right?
No, actually to hike it above zero. That's what's priced in.
Oh, okay.
Yeah.
Oh, yeah. For them to
Yeah.
remove it, yeah.
Yeah.
So that would be an actual rate hike, but that would be a welcome one at that, because BoJ is, now that SNB and ECB are out, BoJ is the only one with negative rate. This upside down of a negative rate hike. But in order for them to do that, they kind of first had to at least lift the upper band of yield curve control as well. So it's kind of like a helpful little side effect that's happening as well, because if JGB 10s are supposed to be at around 0, and then you take the negative policy rate at the front end up to 0, you have a pancake flat yield curve, and you have banks that have no net interest margin whatsoever. So I think that is a possibility, and that would be a policy change, but that wouldn't be as disruptive as what they're doing at the longer end of the curve. So yeah, I think that is a possibility. But I think that's something that they have basically one shot at doing, and that's going to be when new person comes in. If they keep the policy, they're going to be stuck with that policy. They're adopting that policy, and they've inherited it. And then there's nothing. Then they're going to have a horrendously volatile time to get rid of it. This is the only time where you can say, like, thank you, Kuroda, for achieving the 2% target or whatever, and just, now let's pass off the baton to the next era. And make it seem like this was all worth it. This is all like going to plan and all that, and none of it was a policy mistake. And that's the only way that they can do that. So,
Weston, always a pleasure. Go get some sleep. Thank you for joining us. Dale, I want to move the discussion towards the FX ramifications of this move from Bank of Japan. If we look at dollar yen, a move from just above the 137 handle to a current level around 131.5. What do you make of the move in technical terms? Is it possible to come up with a short-term outlook after this?
Well, it is. It's a broken market. So, it's not something I would short. I wouldn't short US dollar yen here. I wouldn't buy it either. It's if you weren't coming in short today, and if you did, you got to be ringing register, because it is December. We could get another comment, and you could see profits evaporate. You don't. It's not a profit till you take it. So I think there are other opportunities where I could come up and manage risk, because we just watched the World Cup, right, Andreas? And the best teams, championships are won with great defense, because if your opponent can't score on you, you can't lose. And in my business, that's risk management. That's defense. So to come into the yen right now and try and trade something that I can't manage to stop, I have to risk 200-300 pips in a blink of an eye. To me, I become a spectator for a while.
Makes a lot of sense, Dale. I wanted to get your perspective on this potential global sovereign debt crisis as well before we move on to some technical setups that you've prepared for today. Yeah. What do you make of this series of events? First Bank of England, now Bank of Japan, potentially the US Treasury market next.
Yeah, that in fact, most guys that wrote about these types of crises developing believed it would start in Europe, and that it would move to Asia, and then finally wash upon the shores of the US. And there's so much going on in debt right now. In fact, Andreas, when they came in, the BOV, to save the gilt market because of pension funds, I said, well, there's probably some people that were pushed out on the risk curve, insurance companies and retirement accounts that have taken big hits because of what happened to bonds last year. And I believe it was this week, President Biden added $350 billion to the Teamsters retirement account. So we have sovereign debt crisis. We're going to have a pension crisis. I believe it's happening here. But at the same time, I look at the bonds, and I think this recent rally that what we're getting right now is actually a buying opportunity. So I think that the bonds are going to rally. That rates have peaked for now. And I think the 10-year could trade down to about 260, 270. And then maybe the Fed's going to come back in later mid-year of 23 and realize that they're going to have to go to work again like Volcker did and like other central bankers in the 70s that thought that inflation had peaked and all it was a pullback and not the top, just a top.
I perfectly agree with that assessment, by the way. I wanted to get your take on a couple of technical setups that you've prepared for today. And obviously, the US dollar is interesting given your view on US Treasuries and the bond market. If we look at the cable first, the pound sterling versus the US dollar. We've seen a retracement from levels above 124, now trading closer to 121.5. What do you make of the technical picture in the cable right now, Dale?
Okay, well, I believe that we put in a significant high on the BOE last week. The fact that 2 voting members voted not to raise rates, and the turn that we had in euro pound is significant to me, which when euro pound is heading up, Andreas, my preferred short's cable, my preferred long is euro. So I would be selling rallies up to 123, maybe 3.5 if the dollar weakened one more time. So there's cable. Say, for example, the dollar does take out the lows from Friday at 103. I'm willing to get long dollars and risk a close on the Dixie under 102. So I'm looking for a recovery, and that should take the pound down to about 117.80, which is a pretty important area to me. Might be analogous to, like, say, 107 Dixie, 108 Dixie. And I think the surprise may be with all these systemic things happening that even though it's not a straight line, that we get a stronger dollar than most people expect. Right now, a lot of people that are dollar bears say, yeah, rally to 108, just a bear market rally to sell into. But if we get through 108, we could be talking, 112 handle, not new highs, but enough to squeeze, allow dollar bears. I mean, sentiment hasn't been this bearish dollar in years. And the dollar came off a parabolic ascent, like the pound up there. And usually there's at least an echo of the strength it had before. So I'm looking for a dollar recovery, and preferred shorts are, I would say, cable over euro, and the Aussie also looks a little heavy to me as well. But I think we'll get that rally to 108 in the Dixie.
On the euro side of the equation, we received news from the European Commission today agreeing on a price cap on natural gas at 180 euros per megawatt hour. I consider that a disaster in the making for next year, since it will not allow European suppliers to buy liquid natural gas if this ceiling is reached in price terms, which may clearly limit the Europeans' ability to act swiftly if they need to fill up storages next year. So this is also a story to consider in euro versus US dollar.
What a tragedy.
Yeah, it is. It is.
So, yeah. So, when you look at natural gas, I'm like you, Andreas. I talk to a lot of smart people, and they feel that this year isn't going to be the crisis year. Yeah. And that next year is something that Europe and the US and everyone really has to worry about. But I brought in a chart of WTI. Yeah. And, as bullish as people were after the invasion, they're that bearish now. And if the WTI chart comes up, we have, again, instead of just making forecasts, I thought I could, it is the season of giving. So I thought I'd share one of the setups I look at for inflection points. So if you look at the crude, the first little dark circle, you had a confirmed low. And then the second dark circle, the RSI was higher, so we were beginning to diverge. And the final one that came in last week, this is called a 3 drive to a bottom formation. I didn't invent it. I learned it from a guy named J.R. Hill in the 70s. Ellioticians would call these ending diagonals. But if you're patient and you wait for these kind of setups, you end up with falling wedges, rising wedges, and two non-confirmations before the turn. So crude's in an interesting juncture here. Looks like if we, start trading, and this chart was from earlier in the day, that we're on the verge of breaking out. And I know a lot of people are crude bears, but I didn't think that President Biden, his limit order was going to be filled at 65. So I did a little front running on this one.
Interesting setup. And given that we've had the G7 price cap on Russian oil implemented, was it a couple of weeks ago?
Yeah.
It's also a very interesting sort of geopolitical backdrop for this trade. What do you make of the macro backdrop and the fundamental backdrop for a bullish oil trade right now?
China reopening.
Yeah.
Okay, so part of this price decline was you had billions of people locked down. So I know it's going to be choppy and fits and starts in China with what they're trying to do, but their central bank is easing, while every other central bank now including Japan, is not. And easy money in China and coming out of a lockdown, I think you're going to see some pretty good economic activity that's going to support crude prices and commodity prices in general.
That's a very fair point. If we move to the outlook for precious metals, I know you've prepared a technical setup in silver, but obviously both gold and silver are interesting to most of the audience watching out there. So quite a run in silver. What do you make of it from a technical standpoint?
All right, well, the silver chart, actually the first two charts I showed a 3 drive to a top in the pound, then a 3 drive to a bottom in WTI. And if you look at the silver chart now, we haven't completed a 3rd drive. We're on our way up there. And if you look at the bottom, the RSI is not confirming. We did take out the prior high, and up around 24.5 is just a guesstimate of where I think a peak would come in. I thought it'd be interesting for viewers to follow this one and see if this one turns into a 3 drive to a top formation. But I think that what we're going to see in the stock market is going to create some risk off in a lot of different asset classes. And I think silver is overdone here. Ellioticians would call this an ending diagonal. And even if it's a bull market from 24.5 to 21, would be a normal correction from where we were at the low. So, I think that the market is ripe. You have a lot of, I think the DSI is around 85, 90 right now, Andreas. So you can't find a silver bear out there unless you're watching Real Vision today.
Good point. Final technical chart of the day, Dale. Equities. What to make of the S&P 500 amidst all this noise?
Okay. All right. Well, last time I was on, or the time before with Maggie, there's a trend line, Andreas, that the whole cosmos, even extraterrestrials, have been monitoring off the high in January. And we had that real good CPI number where the market really blasted up and broke through intraday that downtrend line in the S&Ps. And by the end of the day, it was back underneath it. It gave it back, which was the exact opposite character it had on the last bullish CPI report we had, where the market blasted, it held, and you had to buy that close to participate on a rally. So last week's action, and then the Fed intraday, if that chart comes up, it'll show that they tried to rally S&Ps after the Fed, looking for any bone that might be dovish, like, by 2035, rates should be coming down dramatically. And when they rallied intraday, all they did was get back to that red line almost. They didn't tag it. And then Friday and Monday was kind of sealed it for me. Now we're oversold, and we're due for this little seasonal strength, the Santa Claus rally. It's not Christmas yet. And I could see some type of rally developing here, but I think the market's going to have a hard time closing back over 4,000. So I'd be a seller up around 39.50 to 4,000, and it would take a close back over that red line, like at 40.50, 4,100, to tell me I'm wrong. And part of the reason is the elephant in the room, the stock that everyone owns, Andreas, considered safe, and that's Apple. And Apple is 8% of the market cap of a couple of indexes. So if you put the Apple chart up there, we actually had a breakdown on the 4-hour chart at 140. So I was looking for that breakdown. We've held 130 so far. It would take closes back over 140 to arrest the decline. And just say I was moderately bearish, I think that we could get to that 200-day, 200-week moving average, 110, 115. But if I was a pure technician and I looked at the size of that formation from, that's about a $50, $70 formation, it actually takes it back to the pre-COVID high of $80. And I just don't think the market's going to be able to make much progress until Apple could right itself. And it's on the verge of a breakdown right here. Sell rallies in Apple.
I hope Warren Buffett is not listening. I think 40% of Berkshire Hathaway is still invested in Apple, isn't it?
Well, we won't know he's sold until, 3-4 months afterwards, right?
Sure.
Yeah.
Sure. That's always the case. We have time for a couple of questions from the audience.
Okay.
And well, they center around the big trades for 2023, amidst all this noise from global central banks intervening in bond markets, etc. So given the noise that we've had from Bank of Japan earlier, given the noise from Bank of England a couple of months ago, what is the big trade for 2023 from a central bank watching perspective? Any views?
Short the dollar. After this rally into January, a failing rally without taking out the 114.50 level, you could pick your poison. I believe Euro will outperform cable, but cable seems to lead both ways. I'd like the commodity currencies, and then I'm interested, if I'm correct about this top in silver, to see if it's a break to buy, or that we're really going to surprise everyone and flush it one more time. I'd be looking at miners. Really, the key is wait for the S&Ps to get down to, say, that 3,400 level, because people would be selling everything on a breakdown from the October low. And then the markets that are not making new lows and holding their October lows are your prime candidates for getting long in 2023. My belief is it's going to be shorting the dollar and buying commodities in general. And don't look for the same leadership in the stock market if we put in a bottom in March. It'll be different, and it'll be things that hurt if you drop them on your foot.
Final question from one of our loyal members, Paul. He's thanking us for a nice explanation on the Bank of Japan. But
that was
next
great.
Next question is, what does it mean for retail investors like him? Give us the red, yellow, and green lights moving forward. I'll allow you to start, and then I may add a bit.
Okay. What it means is that expect anything always. Everything can happen. And stay away from markets that could end your trading career overnight. Okay, so, and don't try and make your year in December. I have to ask myself, why in December? Okay, I've seen devaluations in December. So what I would tell him is to find one market he's interested in. You don't have to know 50 markets. I knew traders that were in one trading pit their whole career, in the live cattle pit, and they never had to wander over to the currency pits to trade. Master one market, get to know it, how it breathes, and know every important critical level in it. And above all, use less leverage.
One thing I would like to add in the around the discussion on Bank of Japan is chart 2 I sent you, Brian, on dollar yen versus the Japanese holdings of US bonds, because it's actually interesting that through this period of material weakening of the Japanese yen versus the US dollar through 2022, we've seen selling of US treasuries by Japanese accounts. And actually you have that correlation over time, that every time the Japanese yen strengthens, it usually means that they buy US treasuries as well, because it allows the Japanese central bank to build up FX reserves when the US dollar weakens. And therefore, my counterintuitive take is that what happened today in Japan is ultimately good news for the US Treasury market. So I lean the same way as you, Dale. I think we will get a rally in the US Treasury market into the first quarter of next year, also as a consequence of Bank of Japan's decision today. And I guess that is a green light to watch. In terms of red lights, watch if Bank of Japan starts getting cold feet in terms of the market reaction in dollar yen. If we get a strong rally in the yen and Bank of Japan starts talking to the press about that move, I would lean in the other direction in US Treasuries as well. So Dale, to sum up, it's been a crazy day in bond markets once again. It's another signal that the central banks will have to intervene from time to time to control things. And when we look into next year, it will be very interesting to watch the US dollar in a broader scale, as a weakening move could be on the cards after a near-term rally. And then in stock space, you would watch the price action in Apple, since it's so important on an index level, but also since the technical setup is extremely interesting. Dale Pinkert, the head of trader development at TradeGateHub, it was a pleasure to host you this afternoon.
It was really great talking to you and Wes, so really enjoyed myself today. I learned from both of you guys.
Thank you very much. Thank you very much, Dale, and I wish you a Merry Christmas, and I hope to see you back in 2023 at the Real Vision Daily Briefing. Thank you for watching out there. An action-packed day. I cannot promise you the same kind of action tomorrow, but in any case, I will be back with Darius Dale tomorrow afternoon. See you there.
Great guy. Adios.